Hi, Mount Research Market Insights video for August 24th, 2023. Hey, everybody, Willie Delwich here. Glad you have tuned in. Glad you're listening. It is Thursday, the middle of August, late August, and time again for our 3 for Thursday Market Insights update, where we kind of take a look at what's happening in the market, not go through the whole comprehensive look at the weight of the evidence, but just a few snippets of things that have happened this week, or things I've noticed this week, or things that I just feel like I should highlight this week. So let's get into it. For today's conversation, market still range bound. So August has been rough. If we zoom out, and that's going to be a theme this week, zooming out, getting a sense of context, zoom out. Market is still range bound. The S&P 500, for example, trading where it was in August of 2021. Look at a bigger picture context there. Breadth improvement. Look at new highs versus new lows, where we are from a historical perspective, and then again, historical perspective. From a sentiment perspective, we saw more bears than bulls on the AAI survey this week. First time in 12 weeks that we've seen that. Put that into a little bit more of a historical context. So that's the roadmap. Let's get underway. First up, we have the value line geometric index, talking about range bound markets. This isn't just covering the same level that we covered 2 years ago. Here, the value line is actually still within the range that's been established over the past 5 years. 66 times the index has crossed the 550 level and got close to it again this week. We haven't crossed down below it, but still we're in this broadly sideways market. I think understanding that as we cross over the same level over and over again, it's not, we can't really talk about a market that's making progress. We can talk about sideways action. We can talk about roller coaster rides that kind of finish where they started. That's kind of the market right here. Median stock is where it was 5 years ago. That's not a statement of should or shouldn't. That just is a statement of fact. That's where it is based on the value line geometric index. Look at this, some longer term context in terms of new highs versus new lows. So really, since earlier this month, that improvement that we had seen, where we had started to see more new highs and new lows, that has faded. And the important part here is, even at its peak, this line shows a percentage of days over the past year that we've had more new highs and new lows. Even at its recent peak, 36%, it was lower than any previous low outside of the financial crisis. So even though we've seen some breadth improvement, had seen some earlier this year, that's stalled out a little bit, but it's still, from a longer term context, this broadly weak environment. Interestingly, and I think very importantly, that recovery after the financial crisis, that wasn't half-hearted, that wasn't stilted, that was very much up and to the right. You saw this expansion in new highs. We never saw new lows come creeping back in, which is what we are seeing now. So something to pay attention to as we go forward. From a sentiment perspective, I talked about, on a short-term basis, seeing the shift from excessive optimism to returning pessimism. And so what we've talked about from a longer term perspective is this really excessive and persistent pessimism that we saw following the early 2022 stock market peak. 98% of weeks at its most persistent, 98% of the weeks saw more bears and bulls. That was fading. Like I said, we had 11 weeks in a row of more bulls and bears. Well, that's stopped now. And again, historical context, even at 75%, this improvement over where we were, still higher than anything we've seen. This line goes back to 1990. So 30 plus years of data. We've never been in an environment where pessimism has been this persistent, yet it was fading. Now it's stopped fading. So we want to think about what that could mean going forward if we're in an environment from a longer term perspective with less strength and more persistent pessimism. That is not a recipe where stocks are likely to break out to the upside out of some of those long-term ranges. So that's 3 for Thursday, but August 24th, that's my birthday. So we got a bonus chart today. Here we talked about this in the context of our fear or strength model earlier this week. This is just the fear side of that model. This is the S&P 500, what it's done over the past 2 years. Just overall, that's in the orange here. It's flat. And so one approach would be, well, you just are thankful for the roller coaster ride, to finish where you started. But I think from a tactical perspective, and I think we want to think about this because of the lack of long-term trend, and that we want to pay attention to, and maybe not get into just buy and hold and hope type environment. So in instances since August 2021, where we have had fear in the market, so VIX above 28.5%, 28.5, the market's gained 20%. So $100 turned into $119. In the rest of the time, which is the vast majority of the time, which is the time right now when the VIX was below 28.5, the market lost about 20%. So $100 at the beginning of that environment, that period, has turned into $83. And so from a long-term perspective, lots of sideways with some of those breadth and sentiment headwinds out there. From a shorter term perspective, I think we want to pay attention to, is this an environment where we want to look to make money? Or is this an environment where we want to focus on not losing money? And this approach, looking at it from a fear perspective, would say this is an environment where the focus should be on not losing money. So that's the Market Insights video for this week. Thanks for tuning in. Just I think keeping an eye on some of those longer term trends in this environment where it gets very noisy, where the focus seems to always be, what does the latest day's move mean? Zooming out and keeping focus on this idea that value line has gone nowhere for 5 years. The improvement in breadth, while it was encouraging, has stalled out, and there's still a lot of pessimism out there, which I think from a strategic perspective is a headwind, because at the same time that there's pessimism, there's a lot of exposure to equities, lots of room for investors to start to act on some of that pessimism, and start to reduce equity exposure. So thanks for tuning in. Thanks for listening. I'll talk to you again next week, everybody.